Okay, well, let's. I think we just want to get into that question. We took a question. We take hundreds of questions each week in our chat sessions that we do Mondays and Wednesdays for an hour, hour and a half for clients. We had a question in there we thought would be interesting. We can share that here. It was about essentially which sectors or industries are best to invest in during inflationary or rising interest rate environments. There's a playbook that you hear when you're in school, and then there's what you want to actually use in the real world in some cases. So Brennan's going to take you through that, and then we're going to, rip them apart.
I'm
for whatever
excited.
Excited to rip me apart. Yeah. So yeah, thanks for outlining that question, Ryan. And so yeah, just looking at which sector or industry is best to invest in during an inflationary or rising interest rate environment. Some analysts would say utilities, because many of their contracts are indexed to inflation. I actually spoke to Ryan before the podcast, and I told him this is actually something that I was taught by a professor in school. And other analysts would talk about, consumer staples, healthcare, maybe gold, all because of their defensive properties. But what we would say is to have a diverse portfolio of stocks from many sectors and make sure that you look at the balance sheet to ensure a business does not have too much debt. And if they are levered, that most of their debt is fixed rate rather than floating rate. So they aren't as sensitive to those interest rates rising. So, for example, this was also a question on a company that was actually asked in that chat session. So I'm going to look at Stanley Black and Decker, or SWK, on the New York Stock Exchange. So let's take a look at whether this business would be a good company to invest in during a rising interest rate environment. So looking at the balance sheet, the company has about 408.7 million in cash and 7.9 billion in debt. So that provides a net debt balance of about 7.5 billion. But is this debt sustainable, and is it primarily floating rate or fixed rate? So first, regarding the debt sustainability, the company has a net debt to adjusted EBITDA multiple of about 5 times and a times interest earned ratio of approximately 3.2 times. So just looking at these two ratios, the balance sheet, it is definitely on the higher end of what we would be comfortable with investing in. Now, second, regarding whether its debt is floating rate or fixed rate, I took a look into the company's filings, and the company's 5.4 billion in long-term debt is primarily fixed rate, whereas its 2.5 billion in short-term debt is primarily at a floating rate. So essentially, if interest rates went up by about 1% or 100 basis points, we could assume that its interest expense would go up by approximately 25 million. Now, we can also look at what US rating agencies are saying about the company's debt, right from their 10Q or their quarterly results. So on its senior unsecured debt, S&P had a rating of A, Fitch had a rating of A-, and Moody's had a rating of Baa1. So I believe all of those are investment grade, of course. And then looking at the commercial paper program, same thing. S&P has a rating of A-1, Fitch of F1, and Moody's of P-2. So there were no recent changes to any of the company's credit ratings. However, Moody's Corporation recently changed the company's outlook from stable to negative during the second quarter of 2022, and Fitch changed the company's outlook from stable to negative during the third quarter of 2022. So these rating agencies essentially are seeing a bit of a dim outlook for the company going forward. So just by looking at the balance sheet, this is not a company that we would invest in during a time of rising interest rates. I could also elaborate that the company recently lowered its guidance, which is maybe what caused those rating agencies to lower their outlook for these companies. But, of course, that's a concern looking forward, especially when a company has, this much debt in a rising interest rate environment.
Good job. And I would
So
agree.
rip me apart, guys.
So it's I'm not gonna. No, I honestly, that was a good analysis. So a debt to EBITDA 5 times.
Yeah, 5 times.
Yeah. Okay.
Net
And
debt.
Stanley Black and Decker, this is a tool company. Yeah. So I would
Cyclical.
say like maybe it's consumer. Is it classified consumer defensive, consumer cyclical?
I think it would be cyclical more.
You would
but,
think it is.
I'd have to-
It is a strong brand. So I haven't
Mhm.
looked at the historical financials to see how volatile they've been. But yeah, those sound like pretty pretty high leverage ratios to me.
Yeah.
You know, that said, the rating agencies back them up and say that they're investment grade. So, you know, based on the track record of the rating agencies, I mean, they've always, you know, provided great independent analysis through financial crises and whatnot. So we would definitely just, you know, defer to them and not even
Except for
do any
08.
analysis ourselves. Yes, I'm being extremely sarcastic.
I know.
Yeah. No, I mean, I think that that's a leveraged balance sheet personally. It's the leverage is uncomfortable. And for me, and, you know, 5 times debt to EBITDA. So for some industries, like if you're looking at a utility company, like a regulated utility, maybe that's not that's, you know, typical, right? But the more cyclical a business is, the less visibility and stability of cash flow in the future, the lower you want to keep those leverage ratios. So if you're looking at like a truly cyclical company, you know, you want to have that generally like debt to EBITDA less than 1. You know, most of the stocks, I'd say, like, just without looking at the financials on this company, the 2 to 3 times is often kind of where I see like a lot of the leverage ratios in most industries, which is fine depending. But 5 times is sounds high to me. I mean, once again, I've not looked through the financials myself. So,
Yep.
Yeah, and I mean, the part of the playbook that you typically hear about in a rising rate environment is financials. You know, they can often get a better spread in that environment, but I mean, you got to take each situation economically unto itself as well and look what's going on. Like if we have rising rates in this environment, and for example, I'm not saying this is going to happen or anything, but if the housing market collapses, it doesn't help many of the banks out there that have lent a lot into that segment. So, you know, insurers typically are supposed to do well. And then Brendan talked about consumer staples as well. But looking at each individual business, you could have a consumer staple company that's extremely highly leveraged and it's on a floating rate, and they're going to get squeezed on their profit margins, you know, even though, you know, people need to keep buying their goods. But if they've over leveraged the balance sheet, that's why, you know, we're always loath to just say, this is the sector you buy when rates rise. This is the sector, you know, you have to look at each individual company as well, because you can have a company that should do well in an environment, but if they've done something wrong, like if they borrowed too much money, like we said, and rates rise and it's on a floating rate, they're going to get squeezed on profit margins. So
yeah,
look at each individual company.
Let's go back to what people were saying 9 months ago, right? We had inflation was building up, so there's high inflation. That is what has caused the interest rate increases that we've seen. And people were asking back then, well, what do you invest in a high inflation environment? What was the most common answer?
Right?
Commodities, yeah. Right? And metals and other commodities like lumber were performing extremely well, right? And that was, you know, typically if you look historically, commodities is a place you can go for inflation protection. Well, certainly not this cycle, because commodities over the past 6 to 9 months have been absolutely killed. And, you know, with the exception, of course, of oil and gas. But, you know, outside of energy, like metals, copper, lumber, iron ore, like those commodities have had horrible performance, worse than most sectors, right? So if you are trying to take this investment strategy where you're like, okay, well, I think there's going to be high inflation, so I'm basically going to bet on that, and I'm going to make a guess as to what sectors are going to do well and throw my money into that, you're setting yourself up for complete disaster. And that's what would happen to anybody who went commodity heavy 9 months ago. Now, do I think commodities have a place in a portfolio? I think that they likely do. But these are cyclical areas of the market, very high risk, and you need to invest in them knowing that there's going to be a lot of volatility. So you keep that allocation low and you mix it with other types of businesses that have strong long-term growth drivers. Another thing I'd say, because we've been using the terms like consumer cyclical, consumer staple, consumer defensive. So consumer defensive, consumer staple kind of means the same thing. It means things that people buy regardless of whether or not there's difficulties in the economy, right? Things that you need, like toilet paper, for example. Does not mean that all of the companies that are classified as consumer staple or consumer defensive are going to actually be defensive during a recession, because you have no idea in terms of what just by looking at the sector category, what type of competitive pressures they're dealing with, what types of cost pressures they're dealing with. Cost pressures like everybody else, higher input costs, higher wages, during the supply chain issues, higher transport costs. So just because a company falls into that category, don't in any way assume that it's actually going to behave like that in a recession. You need to do your homework and also just mix it around, like Brennan said. Mix your, and I don't just mean having a little bit of everything. I mean, identifying a collection of strong markets to invest in and profitable companies in those markets.
Yep.
Yeah, I mean, gold stocks, in an inflationary environment, were supposed to do incredibly well. I mean, I'm not saying that that's what we predicted or anything like that, but at the start of the year, there was a ton of questions we got. This gold stock, that gold stock, many gold exploration companies. I did talk at a conference related to that segment at the start of the year, and it was quite busy. Do you guys know what the TSX Venture it has done this year in terms of performance? No Googling it right now. Just give me.
I'd say like 60%, down 60%.
Yeah, it's down 38%. So one of the worst performing indexes in all of North America, obviously, like if not the worst. And it's a proxy for junior gold companies, really, right? Junior metals companies, and that's despite like there are some energy companies, oil and gas, like juniors on that would have had a pretty good year to date. But just the sector is that exchange is absolutely cratered this year. When you think, there's a ton of oil mining companies on there, right? Like it was supposed to be the playbook that commodities were a good place to be in an inflationary environment. As far as those exploration companies, not a great place to be this year at all.
I think that was one of my predictions in 2022 to throw myself under the bus. So